Good afternoon, everybody. Welcome to our investor education program. And today, our topic of discussion would be introduction to spreads. Uh, due to some due to some circumstances, Mr. Ashwini wouldn't be able to take the session. Who was initially supposed to take the session. I am Bhupalini Kodati. I am also from the product team of NCDX. I will be taking the session over for today. We'll start the session in another 3 to 4 minutes. Thank you. So, good afternoon, everybody, once again. I welcome you to our investor education program on introduction to spread trading. Uh, I request everybody, if you have any questions during the session, you can post your questions in the chat box. I'll be happy to take them once I finish my presentation. So before we talk about what exactly are spreads and spread trading, I'll give you an overview of the commodity derivatives ecosystem. So the commodity exchanges are not something that is new, or the futures trading is not something that is new. Commodity trading dates back to the 19th century, wherein we had the first exchange, as in the Bombay Cotton Trade Association, which was established. And then following which we had many regional exchanges and many single commodity exchanges that were launched during the period that is from 1910 to 1930. But and Following which Forward Markets Commission was established in 1953 to regulate these exchanges. Post that, because of the India had faced a certain drought during certain period, during which there was shortage of commodities, and there were a lot of discussions following which there were regularly bans on and off in the later half of the 20th century. And uh, the commodities or the futures markets had to go through a lot of changes. There were a lot of discussions. Basically, committees were set up to understand the function of these markets. And then finally, after the committee submitted their reports, and the government of India had extended the certain set of commodities back then for to be allowed to be traded in the futures market in 2001. And then that is when the few national commodity exchanges had started their operations, which was in 2003 onwards. And post that, also after 2003, the ecosystem has gone through a lot of changes. And finally, in the year 2015, SEBI, which is Securities Exchange Board of India, has taken over as the regulator of the commodity markets. And even after SEBI has taken over, we'll see in the next slide the kind of developments and the kind of changes SEBI has got into the commodity market. Firstly, to understand how the markets are regulated, Securities and Exchange Board of India is coming under the Ministry of Finance, Department of Economic Affairs, and under SEBI we have national exchanges, registered national exchanges, out of which we have currently 5 exchanges which are functional, which is NCDX, MCX, ICX, NSE, and PSE. And 91 commodities are permitted for trading in derivatives market as per the SCRA Act 1972. And like I said, SEBI has been a constant support in developing these commodity markets. After SEBI took over in September 2015, the first thing, the changes started coming in 2017 with the SEBI permitting options in commodity derivative markets, and also allowing category 3 AIFs to participate in the commodity markets. And then post that, we had integration of equity and commodity arms of broking. Bank subsidiaries were also allowed to distribute commodity derivative products, and banks are also permitted to participate as professional clearing members. And then later in 2018, FPIs have also been allowed to hedge their exposure in the commodities market, the Indian commodities market. Basically, they are called as the eligible foreign entities, EFEs. In March 2019, mutual funds and PMS have also been allowed to participate on commodity derivatives. And finally, in 2019, commodity indices have been allowed to be traded. These are a list of some of the commodities that are currently traded on the exchanges. Agricultural commodities. We have cereals and pulses, spices, fibers, guar complex, oil and oil seeds. In cereals and pulses, we have bajra, barley, chana, maize, wheat, moong, and paddy. In spices, coriander, jeera, and turmeric. Fibers, we have cotton seed, oil cake, which is a byproduct of cotton again, and shankar, kapas, and 29 cotton. Guar complex, guar seed, and guar gum. Oil and oil seeds, soybean, refined soya oil, mustard seed, castor seed, CPO, and sesame seed are currently available for trading. So this is a question for the participants. Since which year SEBI has been regulating the commodity derivatives trading in India? 1992, B 1953, C 2015, D 2003. I request the participants to post your answers in the chat box. So how different are commodity derivatives and financial derivatives? Basically, commodity derivatives are very different from the financial derivatives, because commodity derivatives, they are actually settled by actual deliveries. There is a very visible quantity and quality differences that exist because these are tangible commodities. And holding cost includes the assaying cost, the testing costs, warehousing, storage, and insurance cost. Unlike the financial derivatives, wherein we only have the cost of interest that normally is considered as a holding cost. and financial derivatives are purely cash settled, and there are no quantity quality differences that exist for financial derivatives. And commodity derivatives are highly seasonal in nature. Cash markets are active throughout the year, they are perennial in nature. Commodity derivatives, the factors that drive commodity derivative markets are the demand and supply of the commodity, the import export regulations, the government interventions or the government policies, state policies. All these affect the commodity markets. Financial derivatives, the factors that largely impact them are global and economic conditions, performance of the entity, and also taxation structure. So currently, these are some of the financial products that are available for trading in commodity derivatives, which are futures, options in goods, and indices. What exactly is an exchange traded commodity futures contract? Exchange traded commodity derivative contracts, these are offered on a regulated platform and they are executed between two parties where both the parties agree to buy or sell a particular commodity of a specific quantity at a predetermined price for a future date. Okay, and they are standardized in terms of the contract size, the margin, the mark to market, open interest, basis, delivery, expiry, and AgMark is the quality specifications basically. So these are some of the key features of the futures contract. This is another question. Which of the given factors affect the prices of agri commodities? One, weather condition. B, agriculture production. C, changes in import and export policies. D, all the three. I again request the participants to post your answers in the chat box. I will give the answers to these at the end of the session. Now, coming to our main topic, which is the calendar spreads that the session that we have today. So we have understood futures contracts, right? So what exactly is a futures calendar spread? So we have multiple contracts available for any commodity that are traded, the future contracts. So the strategy that consists of buying and selling future contracts with different expiry months together as one position is called a spread. Spread is nothing but the difference between the two contracts, the price difference between the two contracts that the trade is being executed in. It basically involves buying a futures contract for the same commodity in 1 month and selling the contract in a different month. For example, we can consider October-November soybean spread. So you can either buy off October contract and sell November contract, or you can sell October contract and buy November contract, right? So, and this way you are trading on this price difference, the spread. So this price difference is referred to as the spread, okay? And uh, the decision to trade on the spread is basically the spread is basically in a in a futures contract, the spread is basically the cost of carry, and there is a understanding that at any given point of time, if the cost of carry is trading below or over above its nominal cost of carry, then this is an opportunity that market participants see for trade. And this gives you an when somebody enters into a spread trade, the trade is largely dependent on the spread difference rather than the directional movement of the prices, right? So the only thing to look at would be the spread difference rather than the individual prices. And how do calendar spreads profit? Like I said, you are trading in two different calendar months. you're taking a buy position in one and sell position in one. So the price difference that is created because of the price movements in these two contracts uh, gives rise to the spread, and the buy or sell spread that one initiates in these two calendars in the calendar spread gives rise to gives you an opportunity to make profit. So instead of profiting from movement of an underlying product in a single direction, calendar spreads can profit in different scenarios related to the price movement between near term and long term futures contracts. So one popular spread is in the soybean market is the July and November spread. Traders would generally buy the July futures while simultaneously selling November futures, because November is the time for arrival and the prices tend to fall. And July is kind of a lean period. So due to unavailability of the material in the market, sometimes the prices tend to increase. So this way, what would happen is the spread between them mostly tends to be on the higher side. So one can take advantage of changes in this relationship between these two contract months. So what are the different types of calendar spreads? There are two types of calendar spreads. One is the buy spread and the other one is the sell spread. When we talk about buy spread, you are buying the far month contract and selling the near month contract. And when we're talking about the sell spread, you're selling the far month contract and buying the near month contract. So basically, the far month, the action that is taken in the far month, it refers to the spread that is being created. So, like we have just discussed, the volatility in a spread trade would be lesser when compared to a directional position in individual contracts. And the other advantage of trading in spreads is that being less volatile, they also require less margin than outright futures positions. So, which results normally in a futures positions, more margins results in smaller buying power. And unlike in a spread with less margin, you can initiate more positions on the spread side and generate a greater return on the capital. And in most cases, what happens is money lost in one leg of the spread is made in another spread, and that way, the gains outweigh the losses in a spread trade, and thus keeping your trade intact. What are the different types of opportunities, different types of calendar spreads that most of the people participate are? There is the range trading, then there are breakout spreads, there is scale, and then there's technical trading. So in range trading, normally, like I said, there is a defined spread difference between two calendar months, which includes your cost of warehouse and cost of your capital interest. So if the spread is more or less than this range, then this gives an opportunity. And likewise, breakout also, it's the same. When any spread breaks a range, then the market is expecting then to follow a trend, then that also gives an opportunity. Then scale trading is, that the spread between, say, for example, the spread between two contracts has to be 100 and it's trading somewhere near 80. So, the spread has to for somehow come back to 100. So this gives you an opportunity again, buying low and then selling high. And then there are definitely technical indicators which will give you the direction for spread trading as well. Some of the most common spread trading examples are the crack spread between the crude oil and one of its byproducts, reflecting the premium inherent in refining oil, gasoline, gas, or heating oil. And also the crush spread between soybeans and one of its byproducts, reflecting the premium inherent in processing soybeans into soy meal and soya oil. And the third one is the highly correlated instruments such as Brent crude or WTI crude,
नीचे की
London
वीडियो
sugar
हुई इन पे
versus sugar. Like I've already mentioned about the advantages of spread trading, but I will just reiterate them here again. So they eliminate the leg risk for spread traders, and spreads are easier to trade because spread book also brings in more transparency in the market. Spread trades facilitates easy rollover as well. And spreads are easier to analyze, more predictable, and considered less risky as they are less volatile. And spreads have lower margin requirements. So this is my question number 3. Which stock exchange is having major share in trading volumes in agricultural contracts? MCX, B NCDX, CICEX, D BSE. I request you all to post your answers in the chat box. We'll give you the answer later. So what are some of the important factors for spread trading opportunities? One is the supply and demand. So calendar spreads are generally affected by supply and demand factors rather than the money flow or outside influences, because any contract, like any near month contract, the supply for that, the spot month supply or demand affects the prices, and that way the spreads tend to vary because of the spot supply and demand. And the second one is the cost of carry. This amount generally includes the cost of insurance, interest, and storage of the physical grain, or the investment amount required to carry grain from one month to the other, grain or the commodity. And also historical analysis. Historically, we can analyze because, like we've mentioned earlier, commodity. Uh, can I request everybody to be on mute, please? Yeah. So commodities are seasonal in nature, and there is a pattern that they follow. So even historical analysis can be done to study the spread relationships between the calendar, between two calendar contracts. Then obviously we have the fundamental and technical analysis. One needs to constantly monitor everything from production potential to exports or even technical trend lines. A combination of fundamental and technical analysis helps spread traders to grasp what is driving the spread relationship exactly, and how to, which spread to trade and how to trade it. And the fifth important thing is calculate the mean and standard deviation. The mean will give an estimate on how much of the difference is acceptable on a day-to-day basis. And at the same time, the standard deviation will give a sense of variation in this difference. So using the standard deviation and the mean value to calculate the range of spread can also be helpful factor in deciding a spread trade. And mostly spreads in agriculture contracts are also impacted by the stock position in exchange ecosystem, because depending, like again, the supply and demand, if there is a demand for the material and there is no availability in the physical market, then one would like to take delivery on the exchange platform, and this can also impact the spread. And likewise, if there is no demand, one doesn't want to take delivery, and this will also impact the spread. And last one is imposition of exchange margins. Margins also play a very important role, because certain times there are certain contracts, not all contracts, but certain contracts have extra margins. So even this will also, sometimes drive the spread differences between two calendar contract months. So these are some of the margin benefits for spread trade. Spread margin benefit is provided on the initial margins, cash margin, and on additional margin. It does not include the ELM margin. Spread benefit in initial margin shall be permitted in the following cases. That is, different expiry date contracts of the same underlying, and the two contracts variants having the same underlying commodity, and future contracts in a commodity complex, provided the conditions in para 2 are met. That is, minimum coefficient of correlation between future prices of the two commodities is 0.90, And backtesting for adequacy of spread margin to cover MTM has been carried out for a minimum period of 1 year. And initial margin after spread benefit has been able to cover M2M
कुछ भी
on at
आवश्यकता
least
नहीं है
90% of the days as per backtesting. And maximum benefit in initial margin on spread positions is restricted to 75%. And maximum benefit in initial margin on spread positions indicated in the second para, I mean the second point, is restricted to 50%. So these are some of the key takeaways and summarizing the spread trading, that they are less volatile as compared to
क्या कह रहे थे
outright
रुपेश
directional trades, therefore less risky. One second, let me just put everybody on mute. Yeah. The expected profits and losses are small in calendar spreads because the movement is less, they are less volatile. And spread margin benefits are available, which can help a trader take larger positions for trading, and which will also increase the volumes of trade. Directional risk is eliminated. Hence, you can go full throttle on the leverage. And in most cases, money lost in one leg of the spread is mostly made in another leg of the spread, hence negates the overall loss percentage. And in a successful spread, the gains in one leg will obviously outweigh the losses in the losing leg. And can backtest the P&L profile for each commodity futures contract and figure out which contract you can go long on and which contract you can go short based on historical seasonal patterns. Calendar spreads are beneficial to trade in case of an upper or lower circuits during volatile markets. Okay, now this is the fourth question. What is the basis in derivatives contract? Is it the difference between the spot price and futures price is known as basis? B, futures price is equal to spot price. C, futures price is more than spot price. And D, spot price is higher than futures price. Kindly post your answer in the chat box. Now, for the investors, the do's and don'ts for the investor, this is very important. For the do's, read SEBI exchange circulars available on the exchange website. Trade only through exchange registered member. Fill KYC mandate, unique client code. Insist on rights and obligations and risk disclosure statements. Insist on bill contract notes for every settlement. Ensure that the contract note contains all the relevant information such as member registration number, order details, trade number, trade rate, trade quantity, and arbitration clause. And cross-check trade genuineness through trade verification facility available on the exchange website. Pay required margin and MTM obligation in time and understand the consequences of non-payment, and be aware of risk associated with the dabba trading. Don'ts, basically don't deal with unregistered intermediaries. The list of members is available on the exchange website. So trade only with SEBI registered members. Do not undertake off-market transactions, and don't get carried away by alluring advertisements, rumors, hot tips, or any promise of assured returns. Don't start trading before understanding the risk disclosure clause, and don't accept unsigned duplicate contract notes. Do not fall prey to market rumors. Don't let risks against position accumulate beyond your capacity to bear, basically. And don't simply go by any explicit, implicit promise made by analysts or advisors or experts. Don't miss on keeping track of your financial and contractual obligations against your positions. And don't go by the reports, predictions made by various print and electronic media. It's always preferred to do your own research before you trade. And now coming to my fifth question, what is arbitrage? Entering into sell and purchase transaction in the spot market, entering into purchase transaction in spot and futures market, simultaneously entering into sell purchase transactions in two or more markets, and entering into sell transaction in spot and futures market. Kindly post your answers in the chat box. So thank you. We'll now, first I'll give the answers to the quiz questions and then I'll take your queries. Sorry, I just got disconnected due to a technical issue. Yeah, so I was talking about the answers. Yeah, so the first question was since which year SEBI has been regulating the commodity derivatives trading in India? So the correct answer is C, which is 2015. The second question was which of the given factors affects the prices of agri commodities? A, weather condition, B, agriculture production, C, changes in import and export policies, D, all the three. So this was very easy. This is all the three. D was the correct answer. The third question, which stock exchange is having major share in trading volumes in agricultural contracts? The correct answer is NCDX. What is the fourth question? What is basis in derivatives contract? The correct answer is basis is the difference between the spot price and futures price. So the correct option is A. And the last question, what is arbitrage? The correct answer is C, simultaneously entering into sell and purchase transactions in two or more markets. Uh, Now I request participants to post their questions in the chat box, or you can unmute yourselves and ask me your questions. I'll be happy to take your questions. Any questions? I think we don't have any questions. So I would like to thank all of you for joining in our investor education program. And you can post your questions even after the session to ask us at ncdx.com, and we'll be happy to reply back to your queries. Thank you so much for joining in.